Now that all of that is out of the way, let's get to the reason why we're all here, which is our esteemed speaker, Constance Hunter, who is the chief economist at KPMG. KPMG is one of the big four accounting firms, and Constance focuses on macroeconomic research, analytics, and forecasting for the firm. She's also a member of KPMG's Pension Advisory Board. Okay. Constance has a distinguished career of helping to identify inflection points in the macroeconomy. And so this is one of the reasons why we wanted to kind of kick this year off with her outlook, is because she has a pretty good track record of identifying when the turning points are coming in the overall economy. There are a lot of questions going into 2020. Some people are concerned about whether or not we're going to enter into a downturn or whether or not better days are ahead. And so Constance will help give us some guidance in terms of what to expect from the U.S. economy in 2020. Before joining KPMG in 2013, Constance held a number of senior officer positions in the asset management industry, heading up economics at a couple of hedge funds in the New York area, again, dealing with macroeconomic analysis and understanding the different turning points in the overall macroeconomy. So Constance is also the vice president of the National Association of Business Economists. President. Oh, I'm sorry. Oh, wow. We should have charged more for this luncheon. And she's a certified business economist. So for those of you that are thinking about going on and getting that CBE designation, she's probably a good person to talk to about what that might be able to do for your career. She graduated with a BA in economics and sociology from NYU, and she has a master's in international affairs with a concentration in international economics from Columbia University's School of International and Public Affairs. So without further ado, so she has plenty of time to tell us what to expect. Here's Constance Hunter.
Is this the correct ticker?
Yes.
Okay, thanks. All right, and my microphone is now turned on, so you guys can all hear me. Perfect. And in a second, the slides will be loaded. So Ibrahim, thank you for that really great introduction. And thank you for the Atlanta Economics Club, one, for inviting me here. It's a pleasure to be here with you all today. But it's also so great to hear about everything you're doing with regard to outreach to the students within the community. And so this is something, obviously, at NABE, we really encourage our chapters to do, and we're always thrilled when we hear about this. So if there are any students here who would like to have some involvement also with NABE, we do have certified business economics programs with several universities, and so we're happy to assist the Atlanta Economic Club in that type of outreach. So anybody on the board or in leadership at the Atlanta Economics Club wants to get in touch about that, please feel free to reach out. Okay, so we have essentially the question that Ibrahim asked, right? What is going on in 2020 and beyond? And I guess we can't answer that question without thinking about where we came from. And I would say 2019 was the year that the Fed really inoculated the US and even the global economy from slower growth. Right? The shift to 3 rate cuts in 2019 was a big game changer for the outlook, and not just for the US, but globally. So let's just walk through a little bit of that. The Fed isn't the only one keeping it loose, right? We have central banks all over the world are keeping it loose, and we have negative rates in Europe and Japan, and pretty low rates in the UK. I'm going to ask a question I ask often, and frequently I find myself speaking to rooms that are not full of economists, so I expect most of you are going to be able to raise your hand to this, but how many of you feel like you could explain negative interest rates to someone else? Okay, all right. So assuming some of you are shy, I'm going to go with
They're going to understand it after we explain.
Right, well, yeah. Yeah, all right. So, and how many of you feel like you understand, but you would really prefer not to have to explain it to anybody? Okay, all right. So we're going to try this out. I feel so honored to have President Bostic here today, so you can tell me what you think of my explanation. But the way that I explain this to people is to think about the reserve requirement tool that central banks have. And of course, this used to be a main tool for monetary policy, and countries like China still use the reserve requirement heavily, right? And so the idea being that when you have a lower reserve requirement, banks are able to lend out more of their deposits and you get a higher money multiplier, more money is moving through the economy, and this is stimulative. And then of course, if you have a higher reserve requirement, it's the exact opposite, right? So you have less money moving through the economy, fewer of the reserves are lent out. So what happened with the way ECB and Bank of Japan run their negative rate policies is they say, if you put excess reserves at the central bank, instead of paying you an interest rate on those excess reserves, we will charge you a penalty. And so banks were looking at the economic landscape and saying, I'm not feeling so comfortable about lending. So they were leaving large amounts of excess reserves with the ECB. And the idea is this is a penalty for leaving those excess reserves with the central bank. And it encourages lending throughout the economy and almost works to lower the it's sort of as if you were lowering the reserve requirement, but instead of doing that, you're keeping the same reserve requirement. You're just saying, don't leave any excess reserves with us unless you want to be charged a penalty. And of course, by contrast, this makes the prospect of lending out that money much more attractive. And so the ECB was really able to get bank lending going through a combination of negative rates and their LTRO program, which offered an even lower rate for banks who were lending out deposits. So hopefully that helps clarify how negative rates work, at least in the overnight market via the central banks. Of course, this extends out the yield curve, and we'll talk about that later on in the presentation. What does that say about market interpretation of the overall economic outlook? But for now, we have the situation with central banks keeping rates fairly low in order to stimulate growth. And if we look at the Fed and we look at the dot plot, for example, and we take the December 2018 dot plot, right, you can see that there were expectations of rate increases in 2019. And if we go to the contrast from the December 2018 dot plot to the December 2019 dot plot, you can see a real shift in the forecast focus and outlook for the Fed. Right, so a real downgrade in terms of where rates are going to go, and a shift with regard to the terminal rate, R star, or the long-term interest rate. All right, and part of this is coming from the recent negativity we've seen in the global economy. So if we take the number of economies that are accelerating over decelerating, we had that synchronized global expansion in 2017. And of course, that did not last. And we moved into slower growth in 2018. And throughout 2019, we had more economies that were experiencing slower growth than were experiencing accelerating growth. And the cause of this downturn was really coming out of the manufacturing industry. So this is the PMI index, and you can see that Europe is negative. You can see that the Japan is negative. The US and China are positive, but China had spent some time in that negative territory as well, and this really was the main source of the slowdown. Sometimes the press will point to the trade tensions with China and say that that is the cause of China's slowdown. In fact, that does not appear to be the case. It appears that it is China's own credit impetus that caused the slowdown in China. So if you recall in 2015, we had a slowdown in China. We had some disruption in the capital markets in August of 2015. August of 2015. The market was expecting the Fed to raise rates in September, but the Fed held off until December, in part because of the slowdown that was coming out of China. It caused commodity prices to fall. We saw a slowdown here in terms of capital investment, especially in the oil and gas sector. And then fast forward, they said, oh, wait, we slowed down too much. Now we're going to re-accelerate the economy. And that's that increase here in this light blue line. And then if we get to, we come out to the light blue line, should be labeled. It's actually a year-over-year change in credit growth in China. So that started to come down, and this is what caused the global manufacturing slowdown. And this little pickup that you see here, this of the yellow line, is actually corresponds to the Fed's 3 rate cuts. So the Fed impacted not just the U.S. economy, but the global economy. So if we look here at what is going on in China, one of the proxies that I really like to use for the Chinese economy as a gauge of domestic demand that is not, that is one of their more reliable indicators, is this Chinese import volume on a year-over-year basis, and we do a 3-month moving average. And you can see that there has been falling internal demand from China. And we can see here that China has been using their reserve requirement ratio in order to try to reverse this and try to stimulate demand. And if we just go back to this graph for a second, the light blue line is their credit impulse forwarded by 18 months. And you can see that while there was a little pickup, this level of credit growth, which is on this, the amount of private credit that can build up within an economy, and that limit is around 200%. So if we look at previous cases, we have Japan in the 90s, and they got above 200%, but they couldn't sustain that. And part of the reason is because at this level of debt, generally speaking, your interest cost becomes a burden to the economy. And if you have any slowdown in growth, you really see knock-on effects throughout the economy accelerated by the credit cycle. And of course, we have Thailand in 97, Spain just after the financial crisis, and here we are with China. It's kind of reached this limit in terms of how much more credit expansion it can endure. So I would say that policymakers' ability to stimulate in China has kind of run into its limits. And so for me, the best case for China this year is that they keep growth steady. They are going to have a tough time accelerating growth, and there is a significant risk that if growth slows, that you'll see a spiraling of credit defaults and a continuation of issues within their small and medium-sized banks, which has been plaguing the economy and accelerating throughout 2019. And to me, this is the largest risk to the global and the U.S. economy in 2020. So we can see, of course, that this slowdown in manufacturing has impacted Europe, and of course Germany, with a country that has 40% of their economy is going to exports. There is a very significant knock-on effect within the German economy. And this is why I think we had a yield curve inversion at this time last year, right? And when we look at this signal of the yield curve, what I say is that the yield curve is sort of like a thermometer, right? If you take your temperature and you're sick, you know you have a temperature when you're sick, right? And you don't know why you're sick. You don't know, do you have a cold? Do you have the flu? Do you have bronchitis, right? You need to do further diagnostics. And that's the same with the yield curve. The yield curve is sort of taking the temperature of the U.S. economy. And the Fed very wisely paid attention to this thermometer and said, you know, maybe we need to reconsider our rate path, right? And so they went from, we're probably going to hike 3 times in 2019 to we're going to leave rates steady to moving to 3 rate cuts throughout the year. And this This has been done in the past, right? This, what we would call insurance rate cuts, ensuring that the economy does not go into a recession. And in both 1995 and 1998, the previous two times this was done, we had a similar situation. We had a slowdown globally. That slowdown impacted manufacturing. Manufacturing is a heavy, credit-sensitive industry. And so the Fed, by cutting rates, was able to improve not just the US economy, but the global economy. So there's every reason to believe that these three rate cuts will have an enduring effect into 2020. And certainly, as we'll discuss in a few minutes, the US economy is in a pretty good place. One of the reasons I think the Fed is able to be so effective is in part because of the impact of dollar funding on the global economy. So Geeta Gopinath, who used to be at Harvard and is now at the IMF, did work before joining the IMF on the dollarization of the global economy. And what her work calculated was that 40% of trade, not including commodities, is conducted in dollars. So we all know commodity trade is conducted in dollars, but 40% of non-commodity trade is conducted, or global trade that is not commodities is conducted in dollars. And so this dollarization has grown throughout time, and it means that, like it or not, the Fed is exporting US monetary policy to the rest of the world. And so this is a graph from Dr. Shin at the BIS, and what it shows is world goods exports as a percent of GDP. Now, we know that world good exports have started to come down as a percent of GDP throughout this expansion, accelerated recently by trade disturbances. And I say trade disturbances because we're not just talking about US-China. We're talking about the renegotiation of NAFTA. We're talking about US steel tariffs on a variety of countries. We're talking about trade tensions between South Korea and Japan. There are a variety, we're talking about the UK leaving the EU. There are a variety of trade tensions going on globally that are contributing to this. But one thing that Dr. Shin's work shows is that actually the broad dollar index, so this is the inverted broad dollar, really is an important factor in global trade as a percent of GDP, and that when the US dollar strengthens, global trade as a percent of GDP actually contracts. So if we add that, plus Geeta Gopinath's work, plus some other work that's being done on the dollar-denominated debt around the world. So there are a number of ways that we can show this graph. We can show it with the year-over-year change in the value of the dollar. We can show it in the change of Federal Reserve balances, so not just the central bank balances around the world, so the change in the balance sheet impacts dollar debt issuance. And so we can see that, in fact, by the Fed lowering rates, those 75 basis points, they impacted not just the US economy, but the global economy. And we saw liquidity conditions ease here. We saw them ease globally. And of course, that has feedback loops into the US economy. Okay, so delving down into the US outlook, we have had 111 consecutive months of jobs growth, and that breaks any previous record. So previously, the record in the 1990s expansion was 45 months. And so while certainly we have a changing landscape within the labor market, we're producing different kinds of jobs now than we were 20 years ago. We're producing more high-skill, high-income jobs and more low-skill, low-income jobs, and not as many middle-skill, middle-income jobs. The steadiness of the job market has been really remarkable, and I think it's one of the reasons that we have been able to see the unemployment rate get so low. It's one of the reasons we've seen more participation at the latter part of this cycle, and there is a lot of work that's been done by the different Federal Reserve banks and the board, which shows that the longer the expansion, the more able you are to pull different sectors of the labor market back into the labor market and to deploy labor more productively throughout the economy. That said, we are not without concern, right? We're starting to see total labor income decline, which is feeding through into consumption. and consumers are experiencing tighter credit conditions. Now, we think this could be in part to the timing of the survey. We're anxiously awaiting the January survey, which comes out in February. But this tighter liquidity condition and tighter credit conditions for households is an important factor in consumption for the economy and the pace of consumption. Additionally, we're seeing a little bit of a tick up in auto delinquencies. So that is a little bit of a concern, and certainly makes us think about the strength of the auto market, which is the auto sales, which have been under pressure really the last 2 years. So if we look here, we can see that vehicle sales have really been flatlining with a slight decline since about 2016. So if we just look at the levels. Now, when the Fed cut rates, that really impacted the mortgage market. Mortgage rates fell about 100 basis points, and you can see that caused a turnaround in housing. Obviously, housing and autos are two very highly interest rate sensitive sectors of the economy, and we're not as confident that autos is going to make a turnaround. We think that there is something else going on here, perhaps a saturation within the market, perhaps a shift in consumption patterns. So we do expect this turnaround in housing to continue. And if we look at housing starts and real private residential fixed investment, of course, housing is one of the traditional signals that an economy is going into a recession. It's a leading economic indicator. And if you have just been practicing economics since the financial crisis, you might not realize that, because certainly we had a very sluggish recovery in housing, but normally housing troughs before the recession and peaks before the recession is over. So if you look here at the 2001 recession, you can see housing starts and residential investment coming down before that recession and then going up even before that recession had started. So I would say the fact not going to have a recession, but it certainly shows that this is a sector that is perhaps a bit more interest rate sensitive. Anybody who is sort of my age and older in this room thinks that 4% mortgage rates is a phenomenal bargain, but some other people may have gotten anchored to a much lower level of interest rates, and so there's a sensitivity there, I think, within the market that we're seeing in this response in the data. Now, no talk on the economic outlook, in my view, would be complete without taking into consideration potential GDP. So just to recap, roughly speaking, potential GDP is the sum of the growth rate of the working age population plus the growth rate of productivity. And of course, we can't do a whole lot about the growth rate of the working age population, although certainly one of the reasons that U.S. population growth has been so good compared to other OECD economies has been because of our immigration policy. And that shift in immigration policy impacts potential GDP in an adverse way. And we see here that really what it's going to have to come down to is productivity growth. Right, so let's spend a minute talking about the labor market and productivity growth. So one of the things that we've seen, and I think is actually surprising, is that we see a really significant increase in the 65 to 69-year-old portion of the working age population. So this cohort is now bigger than the 16 to 20-year-old cohort, or 16 to 19-year-old cohort. What we see is much lower participation rates from younger labor force participants because of increasing education. And ultimately, this is a really good thing for our economy and for productivity, but there's been this really big shift. Now, this is in line with other countries that have a high longevity. So Japan, which has the highest longevity of any OECD country, has similar labor force participation rates. I will tell you, Europe, which did not even think it was important to collect this data until 2005, has a 5.4% participation rate for the 65 and over population, where the total participation rate in the US for the 65 and over population is about 22%. And if we look at the labor market overall, we see a significant shift in the age composition of the labor market. So, like I said, that younger cohort, which used to be a fairly significant part of the labor market, if we just go back as recently as 1998, is becoming a smaller and smaller portion because of increasing education. And then this older cohort, the 55 and over, is actually the largest single share of the labor market. And then if we look at millennials as they sort of move through here, right, their power compared to this older generation of the labor market is expected to diminish if we go out to 2028. Okay, sticking with the millennials for a moment. This is from some work that was done from the census. And so the Consumer Expenditure Survey, and it looks at the different generations. So in fact, in terms of annual expenditures, millennials are very similar to Gen X, and both of which did slightly better than the boomers. And the big difference that we see in millennials, and you'll see this starts to impact all sorts of things, is the rate of marriage, right? So the biggest impact here is on when millennials decide to purchase a home. And so I don't have the graph here, but there's some work done by a professor at American University which shows that college-educated millennials are purchasing homes at rates that are very similar to previous generations. But non-college educated millennials are purchasing homes at a much, much lower rate. And I think that speaks to the fact that we have a very different kind of labor market now than we did in previous expansions. So this absence of middle-skill, middle-income jobs is really impacting and sort of highlighting that bifurcation between those who have education and don't have education. And what we see is this is impacting overall wealth because, of course, the largest store of most Americans' wealth happens to be in their home. And so not participating in that home ownership stream really impacts your wealth as you go through life. And so this has really broad implications, I think, for consumption going forward. It has broad implications, of course, for monetary policy, for savings. And so this was an important piece of work that was done by the Federal Reserve Board on this subject. Then if we look at this generation, it is a much more diverse generation than any previous generation. So if we think about ways that companies are interacting with consumers, one has to really consider that you are interacting with a much broader and more diverse population with millennials and Gen Z than any previous generation. So moving to the productivity side and tying this all together, one of the things that economists had been expecting as we came out of this expansion was a big increase in capital investment because, as you can see, our capital stock is getting kind of old. In fact, the last time we were approaching anything like this level of capital stock, it was because we were diverting resources to fight a world war. Right? And so there is a big puzzle with regard to why we are not getting an increase in capital investment. And if you look at the amount of CapEx that we have undertaken in this expansion, it has grown at a relatively tepid pace. Of course, one of the things that the change in the tax law was supposed to bring about was an increase in CapEx. Combining that with trade tensions and renegotiating NAFTA did not do anything to really help that cause, right? So it was almost, I would say, an unforced error that could have possibly been avoided and really changed the game in the CapEx situation. But here we are with this subpar CapEx. And while I would say that while productivity is the holy grail of economics, it's probably also the least understood part of economics, which is kind of unfortunate that our most important factor to understand is probably the least well understood factor. And we understand labor productivity fairly well, but even there, I think we have some wood to chop in terms of how comprehensive our models are. And if anyone would like to disagree with me, I welcome that debate, but I will just say to you if there were some sort of recipe that we could apply, and we had sort of like 2/3 of a cup of fiscal policy, 1/4 cup of monetary policy, an eighth of a cup of capex, and you get higher productivity, let me tell you, Japan would have already tried to bake that cake. So we really don't have the right mix, but we know that capex is related to productivity, and we can see that if we look at where we are in this phase of the business cycle compared to previous business cycles, not just the length of the expansion, the amount of time capex has been able to accumulate in the economy, but the corresponding tightness of the labor market, right? So we know that companies substitute capital for labor when labor gets expensive, and we haven't seen that come through in this expansion either. So to me, this is the biggest puzzle and the biggest sort of quest for economists to get their hands around is what is going on with productivity and how do we affect greater productivity down the road, because without it, we're kind of between a rock and a hard place in terms of potential GDP. And this, of course, feeds into a whole bunch of other factors like policy space and where is R star. So what does all this say about our forecast? So we have a basic soft landing scenario, says that the US consumer, which is really pretty solid, not robust, but very solid, and driving services consumption within the US economy is solid and could keep expanding at this pace with relatively low inflation for a fair amount of time before we run into significant constraints. The question is, are we growing at a fast enough pace to avoid global shocks? And so we have shocked our model with a variety of different things, and our model may be a tad optimistic, but our model assumes that with aggressive Fed policy that it would be a V-shaped recession and recovery period, and that the Fed has enough firepower because we are not assuming another global financial crisis. We're not assuming another great recession. We're assuming a garden variety business cycle recession, right? And so for all those people that are out there saying, oh, the Fed doesn't have enough policy space, I think for a garden variety recession, the Fed has sufficient policy space with the overnight rate alone. The question is, do we have a confluence of risks? So this little graphic is born out of my quest to try to describe how economists model risks to a non-mathematical, non-economics audience. So here we go. Everybody is familiar with the game Jenga, yes? Okay. So I can get into Japan's consumption tax, but that's likely to slow Japanese consumption in the fourth quarter slightly. So we can pull out a few of these, right? The tower still stands. But if you pull out too many of them, and again, we are having the phase one signing today, but the phase one still leaves us in a much worse off position than before we started the trade war. And I don't think that the phase one really, so far, has assuaged business leaders to think that now we have a much more stable environment from which to engage in CapEx, right? We still have USMCA to ratify, and to me, for the US economy and US supply chains, that is actually a much bigger nut to crack. And let me just remind you that in the best case scenario, we get down to 13.5% average tariffs compared to 3% where we started, right? So that is still going to impact CPI prices over the course of the next 6 months, and is going to, at the margin, of course, hurt productivity because we know that the most productive sector of any economy is that tradable sector. Okay, so just wrapping up, I'm going to come back to this idea of potential GDP, and this is great if you're trying to study cross-border events and use that to try to help understand what is happening here. And you can see that this is an OECD-wide issue. that we've had slower productivity growth and slower population growth. In fact, in the US, we're lucky. We still have population growth. So Japan's working age population is declining at a rate of 0.3% a year. US is rising at 0.3. European economies range from that 0.3% decline to the UK, which is most like us, which has about a 0.3% increase, to flat. So it's not really a pretty picture in terms of demographics, and it certainly is a challenge picture in terms of productivity, which gets us back to the negative rates where we started, right? Is our bond yields trying to tell us something? We have 25% of global bonds are negative yielding bonds. It might surprise you to know that 11% of these negative yielding bonds are being issued by corporates. If you are a financial in Europe, certain financials are able to issue at negative rates. This is fortunate for them because the pressure is certainly being felt by financial companies, insurance companies, and banks. But this says something about what bondholders believe about the future of the economy, right? So it says something about the beliefs about potential GDP. I think it also says something about the sustainability of debt. And when you look at the situation in China, if we compare it to Japan, so at the time that Japan's debt bubble burst, it was the second largest economy in the world. If we look at all of Japan's private sector debt at that time, it was 23% of global GDP. If we look at all of China's debt to GDP now, it is 30% of global GDP, arguably a larger problem. China is also a much greater consumer than Japan was. Japan was really a net exporting nation, so a collapse in that debt burden in China is really much more significant for the global economy than when we had the corresponding event occur in Japan. So I think that is at the margin weighing on investors' perception of future growth, and why there are investors willing to say, yes, give me 99.7 cents now, or 5 years from now, you're going to give me my money back, that's fine. I'm okay with that, right? It also is, there is a barbell strategy that we see in terms of corporate pensions, in terms of insurance companies, where they'll invest heavily in a bond portfolio, but then go much further out on the risk curve. So one of the reasons that we're seeing an increase in private equity investments and a decrease in public equity, right? This is a pretty significant shift in our capital markets, and I think in part it's driven by such low interest rates. I would say that this corresponds to what's going on with inflation. So the track record for central banks achieving their targets is pretty abysmal. The US is doing the best of any OECD country, and I say that because Australia and the UK are small, open economies, and they have been able to affect their inflation rate not because they've been necessarily able to increase demand, but because they have been able to move their currency and import inflation. So we look here, this is the amount of times banks have achieved their inflation targets, and you can see that Switzerland has never achieved its inflation target over the last decade. All right, so what does this mean in conclusion? There's a lot that you can say about forecasters, mostly that forecasters are wrong. My favorite quote is by George Box. He says, all models are wrong, some are useful. And with the one thing that I feel pretty sure of being able to say is that we are in this rates low for a long time environment. So with that, I am available to take questions if you guys have time.